Welcome back to this quarter's unpacking of the numbers. I'm here with my good friend Bill Bacque, who's arguably the expert when it comes to numbers in the last, 40 years?
Well, I'd rather not pick a number that big, but yeah, it's been actually 50 years.
Bill, thank you so much for being part of this. I can't tell you how much I enjoy the numbers, and it really gives you a feeling of what's really happening by watching these numbers. So with that, I just want to tell you thank you for being here.
Well, it's my pleasure. These are times of change, and I think that's when numbers become most important. The last few years, we've seen a marketplace explode, and now we're facing some challenges to that marketplace that are probably going to be unfolding over the next 2 to 3 years. We're not heading into off a cliff or anything like that, but there is going to be, I think, when we unpack these numbers, an indication that we're probably looking at a market adjustment, and in things such as interest rates, we may be, in fact, seeing the end of an era that has lasted almost a decade, and we may not see those rates again, probably for at least a generation.
Well, and you're right. With things changing, it just makes this even more relevant and more interesting, really, to see how the market is going to react and how it's going to correct itself, and what does correct mean? Well,
and also how everything is interwoven to a certain degree. I mean, the emphasis, I think, for all households, people who have money in 401ks or in retirement funds, or who are filling up their cars, or who are going grocery shopping, are all feeling the impact of what's called inflation.
Right.
And that inflation is driving the Federal Reserve, our governing banking system, to ultimately do some things to try to bring that under control. And the arrow that they have in their quiver is interest rates that they control. And so what we've seen clearly over the last, 9 months is an interest rate environment where those interest rates have actually doubled. And the impact of that is felt significantly in certain items first. One, real estate, because real estate for the most part is financed, and so that interest rate environment that's rising has certainly led to some significant challenges for a home buyer today. That inflation then has impacted interest rates, and what has exacerbated things within our marketplace has been a very low inventory of homes available for sale. So I call it basically the 3 I's. Interest rates, inventory, and inflation have contributed to where we are today. One more added I, if you will, is insurance. And that's something that we're looking at to potentially impact us into the future with rising cost and availability of both flood insurance and homeowners insurance, especially for housing that is south of Interstate 10.
No doubt. And I mean, when you said that just now, like interest rates have doubled just in a very short period of time. I mean, when you think about it that way, that's a huge adjustment. So has this ever happened in your career before?
Well, yeah, it's happened certainly back in the 1980s when interest rates were up in the teens. So yeah, we've seen dramatic rises in interest rates, and we've seen what they can ultimately do to a real estate economy. I just don't see. I was asked that question just this past week. Do you see similarities between what's happening today in our marketplace with higher interest rates with what we experienced in the 1980s? And my answer is no, I don't. Number one, I don't think our economy is in anywhere near as bad a shape as it was in the 1980s, specifically Acadiana economy. Mm-hmm. What we had in the 1980s was a collapse of our local economy that was putting significant pressure on home ownership because people were being laid off. We don't have that unemployment problem. As a matter of fact, Gary Wagner, who's Dr. Wagner is the head of the economics at UL, has cited that although we have not fully recovered from the pandemic, Lafayette hasn't, we've done the best of any parish in Louisiana, and we're still about 4,000 jobs short of where we were at peak employment pre-pandemic. That being said, our overall economy is still relatively strong, certainly more diversified than it was in the 1980s. So I just don't see this as being a recap of the 1980s. What I think it'll be more similar to may well be the 2008-2009 recession, which was directly related to mortgage-backed securities and the failure of that and what it ultimately caused.
Right. Well, I've got all kinds of questions in regards to that, but I think the numbers are going to tell the story. So let's jump right into it. Let's check out some of your analysis on what's happening in this last quarter.
Well, if we look at the Acadiana home sale market, in a moment, come on.
There we go.
There we go. You can see the graph that basically shows you the closed residential sales that are reported to the MLS. Now, this is from all parishes that make up the reporting area of Acadiana. And when you look at this, just the graph visually, you see that basically we have underperformed for 7 of the last 9 months of sales that were reported. January and February were still above last year, but those are the only months where we have outperformed last year. It's been a continual falling short, if you will, of where we were. Looking at September sales were down about 14% from the year before. They were about almost 10% below August. So we see that the dip, if you will, is still continuing to occur. Now, interestingly, although sales total were down 14%, outside of Lafayette Parish, they were only down 2% for the month. And that's something that we've seen as a continuing thing that is occurring, is that we've seen growth that's occurring outside of Lafayette Parish. That's, I think, a direct response to the growth of value, or that is the rise of prices in Lafayette. We're starting to see, especially in new construction, more and more sales outside of the parish of Lafayette. So cumulatively, excuse me, we have closed through September 5,021 sales as compared to 5,592 through September of last year. So we're down about 570 sales through the first 9 months of this year, and about a 10% decline in overall sales. But outside of Lafayette Parish, the decline's only 6%.
Right.
So what that indicates, when the overall percentage is greater than that's outside of Lafayette Parish, that's going to certainly indicate that Lafayette Parish sales are the ones that are taking the hit. And we'll look at that in a little more under the microscope in just a minute. But the next slide, is the overall dollar volume of sales that have been notched outside, throughout Acadiana, including Lafayette. And so while the units, that is the number of sales, were down 14% in September, the actual dollar volume was down only 13%. But when you look at that outside of Lafayette Parish, the dollar volume was actually up slightly. So again, what's being indicated is there is this somewhat of a shift that's occurring outside of Lafayette Parish. And if you go to the next slide, we kind of see that these are the outlying parishes that are reported. And it gives us a good little lesson here, because the general statement when we say, well, gee, sales outside of Lafayette Parish are only down 2%. Well, that's not a uniform situation. They're down as much as 19% in Iberia Parish. But there are some particular parishes where we're seeing significant growth, one being Acadia Parish, where we've had a 25% increase in the number of sales and a 35% increase in the number in the amount of dollar volume in Acadia Parish. Another big one that's kind of a sleeper is Vermilion Parish, that on its surface looks like, well, it's down 3% in the number of sales, but when you look at the amount of dollar volume, it's up 15%.
Right.
And what is that all about? Well, both Acadia Parish and Vermilion Parish are two parishes where there is significant new construction occurring, and those sales are boosting the overall average sales price and median sales price and numbers for those particular parishes.
Yeah, well, to speak on that too, basically what's happening is as inventory decreased, there was less available, prices are going up, and as prices go up, it looks a little bit more attractive to be outside of the parish instead of inside, which is driving more demand just everywhere in general. If there's no demand here in the $200,000 price range, they got to move out to the outlying areas. And then if you're looking at the numbers and we're showing, the increases that we've had over the last 24 months, you can tell, like, we know that Vermilion Parish, they had a moratorium at one point in the last 24 months not to allow any more development because of their utility system. And now that reopened. So that absolutely is going to impact that number, right? I mean,
absolutely.
Yeah,
absolutely. As a matter of fact, there's I believe it's the next slide, which is kind of very telling. It deals with new construction. Your point's well taken, especially for new construction. New construction in Lafayette is not something that's done inside the core of Lafayette. By and large, new construction is occurring on the periphery of Lafayette Parish. Lafayette Parish being a relatively small parish, it's pretty well developed to its borders. So to go beyond the parish line outside to a Vermilion Parish or to an Acadia Parish is not a quantum leap anymore as far as distance when you're looking at new construction. So what this slide that we're looking at shows is the new construction sales, particularly outside of Lafayette Parish, and how much they've grown. When we look at new construction sales totally in Acadiana through September of 2022, there have been a little over 1,050 sales. About 836 of those were in Lafayette Parish, and about 220 were outside of Lafayette Parish. Now, what does that ultimately mean? That 1,056 new construction sales is about a 6%, 5.8% growth overall. But in Lafayette Parish, new construction sales are actually down 2.5%. So where's the new construction boost happening? Well, that 220 sales outside of Lafayette Parish is a 56% increase from where they were last year as far as the number of sales. So of that 220 sales that are outside of Lafayette Parish through September, Vermilion Parish had 111 of them, 50.5%. Acadia Parish had 48 of those new construction sales, or about 22%, and St. Landry Parish had 38 sales for about 17%. And coming in last was about, with 12 sales, was St. Martin Parish, about 6% of the sales. So clearly what we're seeing is a growth of new construction outside of Lafayette Parish. And I think that ultimately that's going to continue to occur simply because of, as you pointed out, new construction always sets the highest level of cost for a house because it's brand new,
right.
Everything's new. Okay. So if in fact you can, through buying new construction outside of Lafayette Parish, end up saving $15,000 in ultimate acquisition costs, that's going to have a significant factor, especially in the growing interest rate environment that we find ourselves in.
And that's what you can see here. And that you've got the average sales price versus, in these outlying parishes versus the average sales price in Lafayette. It's going to be much higher in Lafayette versus some of these outlying parishes.
And because of their new construction, both Vermilion and Acadia, you can see that really influences the overall average and median sales price increase significantly. So you have a 30% increase in median sales price in Vermilion Parish, a 18% increase in average sales price. And Acadia Parish, 8% increase in average sales price, but an almost 19% increase in median sales price. So significant things are happening outside of Lafayette Parish, and conversely, the hit, if you will, in a interest rate environment downturn has really fallen on Lafayette Parish. And so the next thing that we'll look at will be a graph that's just the closed sales for Lafayette Parish. And although the graph, the blue line, which is 2022, certainly follows the overall Acadiana line, that is, for the last 7 months, we've underperformed. The difference, the space in between last year is a little bit greater, and so not surprisingly are the numbers. So for September, we had a 20% decline in the number of sales reported in Lafayette Parish. It's about a 10% decline from the month before. Existing homes sales in Lafayette Parish took the total brunt of the September fall off. They were down almost 26%, while new construction sales for the September were actually up about 2.4. So we can see that existing homes are the ones that are feeling the initial brunt of that interest rate environment increase.
Well, so how much of that do you think is, the affordability versus lack of supply? There is that.
You're absolutely correct. And there is a significant amount of contribution from both. Okay. Once interest rates begin to rise, and let's try to illustrate what the impact of that is. If you were borrowing money in January, a 30-year mortgage, actually the interest rates in January are a little bit under 3%, but let's just use 3%. Okay. Today, if you want to buy that, you want a $300,000 loan, you'll be paying 7%. So that's 4 percentage points that we've gained. It's more than doubled. Okay. The general rule of thumb is for every 1% increase in interest rates, you lose about $10,000, or excuse me, 10%. Borrowing power. So let's take that $300,000 loan that you could get at 3% in January. That loan today, if you want to keep your payment the same, you would basically have $40,000 less that you could borrow. You would be borrowing $260,000. That's the impact of what's going on. And so certainly what's going to happen is exactly the opposite of what we've experienced over the last few years. People were going out and maximizing what they could buy because the interest rates were so low. And so we were moving people up in price range. Now, when the interest rates come down, there are going to be people that are going to have to move to lower price points based on what they qualify for. Right. The problem, though, is that inventory is weakest in both the mid-range, which is $150 to $299, $999, and anything under $150. You have the lowest amounts of available inventory in those two price points. So it's going to be challenging for a person who wants a home to ultimately be able to satisfy that need. That being said, there is a drop in demand that is occurring as the interest rates go up. People are being priced out or may just say, I'm going to sit on the sideline. That's right. Especially because of the rapidity of of that increase. So what you ultimately are are going to be faced with is, again, fewer and fewer people having selections in those price points that are more affordable, exacerbating that problem.
Right, and so I think that's what we're seeing right now, which is interest rates aren't only when they start affecting demand, that's also affecting our supply, because the people who would have put their house up for sale to buy another house are not. So it's keeping that supply off of the market, which is driving the supply even further down. Even though our demand is dropping, the supply is dropping, so prices are continuing to go up. There's gonna have to be a reckoning day where inventory comes up, because I'm reading the national news, which is very interesting. In a lot of these bigger markets that have experienced much higher increases in value over the last 24 months are now, there's more and more inventory. So we're not seeing the same thing that, Atlanta and some of these other environments are having, where that not only is demand coming down, but they're now having more supply, which is taming that average price even more. And so they're seeing both of those, where we're just seeing less demand right now and less supply, at least in Lafayette Parish.
Yeah, you're right. Now that demand is going to continue to slacken. And so even though our overall supply is still extremely low, it is ticking up slightly. But you're absolutely right. And that's one of the reasons why our average sales price, if you move on to, I think it's page 12.
Is this it? All right.
Slide 12, our average sales price, despite the fact that we've had less sales, despite the fact that interest rates have gone up substantially, we still have an environment where you see the average sales price in Lafayette Parish is up almost 11%. Right. The median sales price is up 11%. Now that's to couple with what we saw last year, where the median and average sales price rose 12%. Mm-hmm. So in 2 years, we've had about over 20% increase cumulatively in both average and median sales prices. That's an enormous increase, and it's not actually, at least at this point, we're not seeing that turnaround. It may over some time.
It won't until we have oversupply. I mean, as long as supply is low, we're still going to have increase in demand. Right?
You will, or you will have no demand at all.
Right.
If interest rates get so out of whack, which I'm not really anticipating. One other thing you see here also is that there is a difference, obviously, and we talked about that, between new construction, which typically sets the high, and existing homes. So although existing homes have risen in value in Lafayette, they're up 9%, whereas new construction's up about 15% on both average as well as median sales prices.
Which that has driven in the last 24 months the builders to go ahead and build more. Now we're having more now that the interest rates, I mean, and the new constructions, they're 6 months out, right?
Yes.
Approximately. So I've already seen, some of the decisions that these builders are now making. They're definitely taking into consideration the affordability and the concern of, are we going to be oversupply? However, at the same time, we don't have enough supply, at least in my office, the boots on the ground. We still are constantly looking for houses for people. There are people who are coming off the fence.
Well, sure.
And, but here's another point I wanted to discuss with you. It seems like when these type of events happen, when we had COVID happen and with the initial, it was March, April, May. I mean, demand was definitely way down. And then the summertime came and, right. And it was like, the people, decided it's not the end of the world. It's, the changes in their life still happen, is right. My point. They still have babies. They still graduate. They still move out of mom and dad's house. Right. But they delayed that, and we had a significant amount of buyers that came out in July of 2020, and then with the interest rates, it flourished. However, I guess my point is, or my question to you is, have you seen this type of environment before, where it's an up and down thing, where it's the demand doesn't really go anywhere? It's still there. The supply and demand is still there. It's just delayed. So it's like a pent up demand and pent up supply. I think you and I had talked about this in 2020. I was like, I feel like the buyers were always there. Nothing's changed. They just waited. And I felt like we definitely saw it in our numbers in July. I think it was July, where we saw the interest rates were going up and down, and then they went down, and we had this huge surge of buyers that came out.
Right.
And we actually, September was way better than we thought we were predicting based off of the previous months. Our pendings were up in August. And so anyway, I felt like it was an interesting thing, the dynamic where the supply is still there. People are still gonna pass away, move on. Their life changes don't stop. However, they're just waiting for that right time to either put their house up for sale or go out and buy one.
To address your point about the distribution of homes available, I think this graph really points that out. It's where we divide up the total sold properties into various price quadrants. So the far left, you have those that are sold below 150. Then that middle one, which is the largest segment, is those that are sold between 150 and 299, the affordable, if you will. And then you have the 300,000 and up, which it is, I classify it somewhat arbitrarily as the upper end housing beginning.
Sure.
So one of the things you see is in below 150,000, there's not a whole lot of sales that occur, meaning there's not a lot of properties available under $150,000. As a matter of fact, those sales are down. They were off by 26% from last year, but more importantly, they represent now about 12% of the sales in Lafayette Parish of that market. Just last year, they were 14%. Okay. 10 years ago, it was about 30%. So we've basically lost that affordability range. The mid-range also fell from last year by 21%. This price range compromise or makes up about 57% of Lafayette Parish sales through the third quarter. Last year it was 63%. So then we have the 300,000 and up. Those sales are the only quadrant that increased so far this year. They're up almost 20%. And they now represent 31% of the market, up from 22.8. My point being, yes, as you have people needing to transition into less less expensive housing, we have less and less availability of that housing in those pricing quadrants. And that's going to be a challenge looking forward. And the real key to that is ultimately going to be interest rates. You had mentioned about inventory, so let's take a look at that inventory, particularly the next graph, which would be the new residential listings, new listings coming on the market. Okay. And as you can see, it's kind of a mishmash when you look at the comparison to last year. But overall, there's only been a 3.4% decrease in the total number of listings that we have taken throughout Acadiana. But the reason that the listings are so low is because of what's happened outside of Lafayette Parish. New listings outside of Lafayette Parish are up over 11%. So they're down by about 11% in Lafayette Parish. And when you look at that, new listings, new construction listings are down about 11%. Existing homes are down about 11%.
So 11% Lafayette Parish, and we and what is the sales down? About 20%,
right?
Number of
right,
sales.
Right,
So there's a 10% deficit there,
right?
Yeah, or delta.
And that's new listings coming on the market. And your point's well taken. If I'm somebody who's sitting on the sideline wanting to buy a home today, the likelihood, based on what's out there, inventory that's out there, depending on the price points. And we'll look at those in a minute. You may have only 5 or 6 houses that are available in your particular price point. Well, you've seen them all.
That's
okay,
right.
And none of them meet your needs. So now, as one listing comes on the market, suddenly there's a lot of eyes that are looking on it. So your point's well taken that a good listing that comes on the market right now can still see a lot of attention because there's so limited amount of existing inventory that is on the market.
Well, I mean, all of our experience and all of our training has said, if you're looking at these numbers, it's a seller's market. I mean, if you have a house to sell, it's a great time to sell. The challenge becomes, okay, well, what are you going to buy? Because unless you're downsizing, it's going to be hard to upsize with interest rates and affordability at a low.
You're absolutely right, and actually, they're coining a phrase now that says that we may be moving into an era with these increased interest rates occurring, wherein you have existing home stock sellers, potential sellers, who are actually trapped in their homes. According to the National Association of Realtors, they estimate that as much as 90% of the existing households in the United States have interest rates that are under 4%. Now, how can that be? How that can be is that over the last 10 years, when we've been in this low interest rate environment, if you weren't buying a house and getting a low interest rate, you were refinancing your house and getting a low interest rate. So let's say I have a 4% interest rate on $200,000 worth of debt and I want to sell my house. Even though I have equity, might have $100,000 worth of equity, I have $200,000 and I'm paying 3% on.
Right.
Now I got to replicate that in the marketplace. I got to pay 7% on it. So I'm losing my buying power of my equity proportionally, and that's going to make sellers more and more hesitant to do things. So we have to ultimately get into a different mindset about interest rates. And I heard this story, and I think it's very relevant, told by a real estate agent from Florida who's been in the business 50 years. And she said, last year, the environment that we were in, and you probably will remember it because you had a lot of people talk about it, there were multiple buyers typically looking at homes at the same time. There were multiple offers. And generally, she said, what I would advise a buyer last year was, look, we have great interest rates, once in a lifetime interest rates. But we don't have a lot of homes on the market, and people are scooping them up, and they're outbidding each other, and it's just crazy. So you got to love your interest rate, but you're not going to. Likely is you're not going to get the house you love because you're going to be outbid for it. So what you may have to settle for is a house you like that you could fall in love with. Okay. That's what we had last year. She said the dialogue now today is completely opposite. It is now let's wait till you find the house you love and you're going to marry that, okay? You're going to get a rate and you're not going to marry that rate. Last year you wanted to marry your rate. Yeah. Now you want to marry your home, the one you love, and you're going to date the rate.
Right.
Meaning that the average person lives in a home for 13 years. The likelihood over the next 13 years that interest rates are going to fluctuate, not just upward, but also potentially downward, are pretty strong. So the idea that you're buying an interest rate today that is your interest rate for life is not there. And,
that's right.
And as soon as we get that mentality out of the buyer's minds, that because again, they've been conditioned to a decade of low rates, that these rates may never be here again. So let's find the house you love and date the rate.
That's right. And we're already seeing that in the mortgage industry, at least on the ground. We're already hearing every day lenders calling us, hey, we're going to do a 2-to-1 buy down, which means, you can buy the rate down 2 points the first year and then 1 point the next year. And then assuming interest rates are going to be lower, it gets you the house that you want and a reasonable rate with the anticipation of a potential rate decrease in the future is what they're doing. And then I know in the 80s, I mean, you guys had to deal with this. I mean, y'all had interest rates in the teens. I would imagine, I know from the seller's perspective, we want to do things to attract the buyers to buy our house versus another house. So we're talking about the 2-1 buy down. Like, hey, why don't we offer the 2-1 buy down up front? Or I would imagine if it keeps going up, you're going to start to see more owner financing situations where, if you want like a luxury house and you can't get the interest rates you want, come into some type of agreement with a balloon payment with the owner.
That certainly could happen. I think it all depends on what the ultimate level of interest rates is going to be. Right now it's 7.1%, and I know that's a sticker shock for somebody who might have been in the marketplace just 6 months ago. But what we've got to ultimately do is to say that's past history, and put it on something that an owner would understand. I'm in a listing appointment, and they tell me, hey, my neighbor next door 6 months ago just sold his house. He got $20,000 more than he's asking for it, had 15 offers. How come my house is on the market a week and I hadn't had anybody look at it? Well, it's a different world. It's a different environment. And I know it's been a short period of time for you to experience that rise. But all you have to do for looking for a parallel is how you doing on your 401k, okay? Right. How'd you do this year versus last year? And I think most people will ultimately say, I'm not doing very well at all. Well, that's the same thing that we're in here, okay? Sure. It is what it is. Now, if you don't want to be in the marketplace, then don't be in the marketplace. But if you're in the marketplace, you have to be in the marketplace that is, not the one you want. Yeah.
So, and we mentioned this before we came on that we're comparing our numbers this year to an outlier for the last, like you said earlier, we had a 20% growth, in 2020 to 2021. And now, it's more reasonable. Where do you see us compared to like pre-COVID?
Well, I think we're ultimately going to go back to a level that's more indicative of 2018 pre-pandemic. I think that may take 2 to 3 years, but I do see that the market is not going to suddenly reach back to that overheated level. Again, just to illustrate, okay.
Want me to change this?
Well, it's slide 32.
There you go.
Yeah.
All right.
This kind of gives you an idea of how crazy, if you will, things were over the last 2.5 years. You can see in 2018, Lafayette was not in a really great place economically in 2018. We were having some disruption in the oil industry. What little oil industry there still was or is in Lafayette, that was a challenging year. But still, we had 5,268 transactions. That was our first year breaking through to 5,000 transactions.
I remember that.
And the first year we broke through $1 billion of sales.
I totally remember you.
That was 2018. Okay. 2019, we had about a 6.2% growth in the number of sales, about an 8% growth in dollar volume, which follows the traditional. If we go back to the 1990s and look at growth over that period of time, it's generally averaged somewhere between 3 and 5% growth. Okay. Now we get into 2019 to 2020. And suddenly, and you're right, First 3 months of 2019, we had the shutdown of the economy. Nobody was buying or selling anything. And it was in that 3 months where everybody learned about maybe it's not such a kumbaya moment to have a 1,500 square foot home with all the kids and mom and dad all at home at the same time. Maybe we need to get a bigger house.
Yeah.
Okay. And you had lower interest rates, and you had the government giving tens of thousands of dollars away to everybody.
Yep.
Okay. So people had cash, they had low interest rates. Let's go out and boogie woogie. And we suddenly went from 2019 to 2020. We're now over 6,000 sales in 2020.
And don't forget, like when we were coming out of COVID, we had a lot of supply. I mean, compared to what we are dealing with now. I mean, in July of 2020, when we had buyers come in and said they want to buy a house, we could find their houses.
You could, but it was still a relatively tight market. It was still like three to 3.5, 4 months overall. Now we're down to maybe 2 months right now overall.
And we were living at 1.5 for, up and down a little bit for the last 24 months.
Right. So ultimately, what we saw in 2019 to 2020 is an increase of 10% in sales and 21% in dollar volume. And then 2021, we go above 7,000 sales, 7,300 sales, and $1.7 billion. So from 2018 to 2021, we've had $700 million increase in sales and over 2,000 increases in transactions. That's not sustainable. So it's going to come down. I believe we're probably going to see. It's not going to happen this year, as you can see on the slide, the title. We're still on track to be the second best year ever at the end of this year, based on our current numbers, which is 1.275 billion and a little over 5,000. But we will not get to that 7,000, and we're not going to see that 7,000 again, probably for a number of years.
Right. Well, that's interesting because, what in the 80s, there was a big, the biggest difference that I could see. I wasn't working back then, but I do know from the stories and from what you've told me is, the last one out, turn off the lights in Lafayette, the bumper stickers and everybody, that was a major difference from what we're experiencing today, which doesn't seem we're losing population here in Lafayette. So they're still here. Is it just going to be they stay in their house for longer before they decide to make that decision?
I think that's certainly going to be one factor that people are going to be looking at. I think that also you're going to see some movement in those the 150 to 299. You're going to see some stock growth there. One of the things that you brought up that looks to be a stimulus for stock increasing, the stock of housing increasing in the future, is the fact that the baby boom generation, my generation, if you will, we're all getting old. I'm on the tail end of the baby boom generation. I was born in 1951. I'm 72 years old. I have a house, okay? My wife and I have a house. At some point, we're not going to have that house anymore because we're not going to need it. We're going to need something a lot smaller. So I think that there is what we call this silver tsunami of housing that is out there that portends well for a future amount of inflow of housing stock. And typically that type of housing, estate housing, if you will, in many cases it is mortgage free. So you have the elasticity of being able to make transactional deals. It's not your own personal home, it's an estate home. So I do believe there are things coming into the future that will portend well for inventory. But I think the challenge right now is ultimately the coming to terms with where we are. And the biggest part of that is the interest rate.
Before we get to that, since you're talking about the silver tsunami, I mean, when you say something like that, it sounds like to me, and it's apparent. I mean, if you drive up and down West Bayou, Kings Road, I mean, those houses are usually not
available.
And they're not available, and they're not our age. They're not in the lower under 50.
Right.
And so I guess if I was a baby boomer and I heard that, I might conclude that this would be the time to sell before the tsunami comes, which is going to create more and more inventory in that price range, which is going to drive the price down. It just seems like that might be the move if you are anticipating a ton of supply coming onto the market in those upper end properties.
It's certainly a strategy. Mm-hmm. Whether it's the right move or the wrong move or whatever, we it's like, well, did I sell my stock too cheap or should I held it? What you do is you make your deal and you move on down the road.
Yeah.
And things work out.
That's right.
And things work out. As far as a crystal ball, there's not really a lot of that I'm willing to do. Matter of fact, I was contacted recently about wanting to know whether I would be willing to engage in forecasting for a development of X price range housing. And I told the gentleman, I said, in this interest rate environment, I'm not into forecasting anything. Mm-hmm. I'll tell you what's happening, but things are so chaotic right now with what's the Fed going to do. The anticipation is we've got at least another 75 basis points rise in their pocket, maybe two more occurring between now and first quarter of 2023. So we could see this rate environment ultimately before we can get inflation tamped down. We might be seeing interest rates for 30-year mortgages, at least for some period of time, in the 8.5%. So I think there's still some uncertainty out there. But just the environment that we're in right now is starting to show up in pending sales. And I think that's one thing we look at. Pending sales do give us some indication of at least what the market's going to be like over the next 60 days or so.
That's right.
I wouldn't go back further than that because what goes under contract today is closing in 30 to 60 days. So we can see that in September, pending sales were down. They have been down actually for 8 out of the last 9 months. So we've seen that pending trend moving downward, I think in correlation with the interest rates environment. Overall, they were down from September of last year by 6.7%. In Lafayette, they were down 5%. So they were a little stronger in Lafayette. Dollar volume,
which it went up from August.
It did, but those are going to be adjusted downward through fall throughs.
Right, but do you think that was because of the uptick and downtick of the interest rates?
I think there are a lot of people who are bench sitting right now, and they're looking at a tick this way.
We know
or
that's
a tick
happening
that
because
way.
we're having our mortgage guys. They're like, lock us in.
Yeah.
They're watching that interest rate and they're trying to get the lowest rate. And there's another part of that too. I think, hey, look, interest rates went up. Then it took people off the fence, and now. If any kind of downturn, it's like, hey, you know what? It's not that bad. Right. I was going to be at 7%. Now I'm at 6.8.
So those pendings dropped 6.7% for September. The dollar volume of those pending sales dropped by 7.5. So that's an indicator of what's going under contract. Right. They're buying less expensive. Now, not dramatic, but it started. It's a movement. And the 122,780,000 in pending dollar volume is the lowest monthly pending volume since December 21. Okay.
Wow.
So again, there is this movement to less expensive. In Lafayette, the pending sales were down 7.2%. The dollar volume was down 10.5%. And the 84,500,000 that was pending dollar volume in Lafayette in September, that's the lowest pending dollar volume since December of 2020. So when I talked about where are we headed, I think we're slowly headed back to a more normal type of cycle, which if you take out the two outlier years of 21 and 20, we're going to get back to about that level. And that would seem to a person who just looks at it, well, man, the market's really gone down. It is an adjustment to normality as opposed to a market that is falling.
Right,
okay?
Right.
And, one other...
And I think that's an important part. I mean, because you could look at these numbers and you can say, man, what's happening? But we're comparing these numbers to outlier years. So, it's very hard to get a picture of where we are in relation to the last decade.
Right, right. And in fact, looking at that, when we get there, this is 31. This is an interesting slide looking at interest rates, and I think I have the heading saying perception is reality. What's happening right now is the perception is that interest rates have gone up substantially.
Right.
Okay. But ultimately, if you look at this, and this is a 60-year window that's been put out by the Federal Reserve, or actually Freddie Mac. And as they say, between April of 1971 and June of 2022, 30-year mortgage rates have averaged 7.8% over time. So what the environment that we are in is not this, oh my God. As a matter of fact, you've gone back and mentioned about the 1980s. Well, the 1980s, when we had 18, 19% interest rates, we're not there either, okay? We're in a normal range of where we've been over the last 50 years if you look at the average rates on mortgages. The problem, though, is from 2000 through 2022, we have been in an abnormal interest rate environment, primarily brought on not by market conditions, but by market stimulation that's occurred either by the federal government's pumping trillions of dollars into the economy, or by the Federal Reserve cutting interest rates to zero. And that's what we've lived under for basically a decade. And it's going to be hard to shake that perception of that being reality out of our minds, because it isn't reality if you look at it from the long haul.
Right.
And this is the chart you need to be showing your buyers and basically
I love that
saying,
chart. Yeah.
This is the normal line. Okay. And we're back to normality. So.
You want to go to the next one, or?
The next one I think we've gone over. There is one other area where we could ultimately look at, and that begins on page 21. And when we look at our existing inventory, we looked at new listings coming on the market, and we know that those are down, not down substantially, but down. What the second thing we look at when we're looking at overall inventory is what's on the market right now. And this chart basically tells us that when you have a marketplace where you have 5 to 6 months supply of product on the market, a 5 to 6 months supply of product means the active number of listings, the average that you're selling. In order to sell all of the inventory that you have now based on this amount of absorption, it would take 5 to 6 months. Right. And that is what the experts say is equilibrium. That's a market imbalance. So that when you have 5 to 6 months inventory, you've got a limited amount of pressure upward on prices and a limited amount of pressure downward. The more you get away from lower of those 5 to 6 months, the more you have more demand chasing fewer supply, Hence, you get lower number of months supply. And the converse is the more you get more inventory than demand, the more you get pressure to have lower prices. So 1 to 2 month worth supply is where you will get double-digit inflation or appreciation. And remember, our average sales price is up about 9% in Lafayette. So what's our number of months supply of product in Lafayette Parish? Right now, 2 months supply of product. Last year, it was 1.3 months supply. So we have had an increase in inventory. Now, the interesting thing is we go and break this down. Under 150,000, you can see on the right, in the middle column, is the number of active listings. And then on the left side is the number of sales. So you go down and you can see, well, in many price points, there's no listings available.
That's it.
Okay. And then you have 2 or 1 or 2 or 4. The most in this price point is 8 listings in the 100 to 109,999. So if you're shopping in that, like we talked about, you've probably seen everything that's on the market.
That's right.
Okay. And you're waiting for it. So if overall it's 2 months supply, in this price point, you got less than a month's supply. Now, last year, it was the same thing. Then you have the next group, and that's that 150 to 299, and it's not 2 months, it's 1.4 months.
Right.
Okay? And again, you can see the low number of listings. Now, once you get up into the 240, 230 range, you may get a little bit of selection. But for the most part, you still have very little selection. And then you have much more selection in that upper end. Where you have a 3.6 month supply of product. Last year it was 3.1, and you're seeing some 9.9 month, 9 month, some closer to equilibrium or above.
And a couple of years ago, that was at like 30 months.
Right. Right.
So like in 2019, in the upper price range, it was, over 20 months of supply.
And this is probably the price point where you're going to see the most growth in number of months supply, because you as people are priced out through more in interest rates, well, they can move down, but you can't really move up. If you're in that 300 and above, there's not any place else you go. And so I do think it has the potential for the most saturated of our price points.
And what's interesting though is in the upper price range, what we see, on the ground, and when we're dealing with these luxury buyers and sellers, that they're not as sensitive to the interest rates either.
No, they're not. But they are sensitive to their net wealth.
That's right.
And so the wealth factor does figure into this. What's happening in my investments? So if I've lost 30% of my portfolio value, although I'm not sold anything, I haven't actually realized that, I'm not feeling the wealth quotient that I might have been feeling a year or so ago. But then again, also that being said, the super wealthy are looking for hard assets that they may want to put their money in, especially if cash is in fact not yielding you anything at all, or losing value through inflation. And hard assets may in fact be one thing that they want to look at. What we can say is that clearly, looking at Lafayette sales of $1 million or over, there have been 31 transactions so far this year of people buying homes in Lafayette Parish that are $1 million or above. There are 34 that are actually on the market right now.
Right.
So we have a healthy inventory of upper priced homes, but if you're shopping for a $90,000 home, you ain't got a whole lot to choose from.
That's it. And that's why they're starting to move outside of the parish.
Absolutely.
And that's where the builders are building.
And even existing stocks of housing will be at lower price points.
Well, we're getting to the end of our time, but before we end, I want to know, like, if you're speaking to a builder, okay, so I see these numbers. If I'm a builder, this looks promising. There's low inventory. If I can build under 300,000, what would you tell a builder at this point?
Well,
because you got to, as a builder, you're not just looking at today. You're looking at 6 months from now.
I get you. I think what you look for is we're going to enter into an era where what I put on the ground has got to attract the buyer. They got to fall in love with the house in order to date the rate. Okay. And so it's going to get more competitive, and you're going to have to dot your I's and you're going to have to cross your T's. And I know how difficult that is with the cost of materials, the cost of labor, all being crazy, over the last couple of years. It's tough to be able to set a price point and hold to it. But I think it's going to become more and more competitive. And that's why I think more builders are, in fact, especially those who are the volume builders who build in that middle range, are looking to go to wherever they can cut some cost to put product down. And that, in fact, is contributing to the sales outside of Lafayette Parish.
It's interesting because the perception of the high interest rates are definitely impacting the builders who are planning the next 9 months. And I'm predicting that even if we still have high demand, I think we're going to see lower inventory in the new construction. Just from my conversations with builders, they are hesitant to start that next project. And I think we're going to end up in a situation where we need more housing in the next 9-10 months from the new construction. I think we're going to have a lot of demand in that price range still in the underneath $300,000.
I agree with that. And actually, one of the things that we've seen as far as numbers of new listings that are occurring, even though overall sales of new construction are up, still slightly, all parish, Acadiana wide, that they are putting less inventory on the ground now, because they are, in many cases, we have regional or national builders here. Their strategy for what they're doing in Lafayette is based on what their national strategy is. And it is exactly what you said. Right now, in the environment that we're in, we need to kind of lay back on our inventory, keep it very tight as far as the number of units we have on the ground. And I think you're going to continue to see that.
And if you're a home buyer, a new home buyer getting into the market, what advice would you have for them?
Again, buying a home, it's not an ATM. It's not a savings account. It's a house. It's an asset, but it is home first and foremost. You're going to be paying somebody for shelter. They're still long term. If you look at any graph of holding an asset, in the long run, it will ultimately pay off for you. And even with mortgaged funds, the one thing you gain when you have a mortgage is leverage. And that is, you're not putting up the entire amount. I buy a $300,000 house. I'm not putting up $300,000. I might be putting up $15,000. Okay. Well, the appreciation, if there is any appreciation on your asset, let's say it's only 3%. You got 3% not on your $15,000. You got 3% at appreciation on the $300,000. Right. So in 1 year, that's a $9,000 appreciation. Right. On a $15,000 investment, that's not a bad return.
Right.
Okay. Now I recognize you got to put out your principal and interest, your monthly payment, and your taxes, and your insurance, your maintenance, and all that. But you're going to ultimately be living somewhere. Okay. If you're paying rent, you're paying it to someone else.
That's right.
If you're paying on your note, you're paying that note on your behalf. And so there's still upside for home ownership. And the other part of that is, and we certainly learned it through the increased demand of the pandemic, and that is where you live with other people is extremely important to the well-being of your overall lifestyle and how you live. And so that's not going to change.
Right.
Fall in love with your house.
I love it.
Date your rate.
I love it. I love it. Well, we're going to end on that, Mr. Bill. Can't thank you enough. It's an honor to have you here, and I really appreciate you taking the time out of the day to explain this to everybody here in Acadiana.
My pleasure to be here. Thank you, Jim.
So we're going to be doing this every single quarter. If you want to find out more and get our market updates, just go to LafayetteMarketReports.com, and where we break down each price range every single month, and you can take that to the bank.
Well, amen.
Thank you, guys. Appreciate it. We'll catch you next time.